What's up, guys? Welcome back to another episode of Cash and Confidence, where we talk money, market, power, and respect. I am your host, Mo Money, and how are y'all feeling? Y'all feeling like money, wealth, success, freedom? Good? You feeling okay? Leave me a comment, a like, subscribe, send this to a friend, rate, join the VIP newsletter, whatever you want to do. It doesn't matter to me. It does matter. I love y'all. Thank you so much for listening. Anyways, quick recap from last week's episode. We spoke of the money map and budgeting, right? We talked about giving strategy to your money on what it is it needs to be doing. And we talked about the 70-20-10 method, where we spoke of investing for the 20%. We spoke of sinking funds or charity for the 10%, and then just having fun, right, for the 70%. But this is all after you've paid your bills. So make sure your bills account is receiving its dues. Clock that, team. So yeah, we talked about all that last week. This week, we're going to talk about specifically honing in on the 20%, which is investing. And this is going to be a surface level, bringing you into investing talk first. And as the season progresses, we will continue talking about the different avenues of investing, because that's going to be your biggest part of your financial success. We've talked about the things that help get there, but those things are what leads us into where we're going now, which is all about investing. And to be clear, there is a difference between investing and trading. This episode is about investing. They're both kind of the same thing, but trading is a little more fast-paced depending on how you trade. And there will be more details on that later. So this week's episode is going to be called The Wealth Circle. What is investing? Why does it matter? Right? Well, investing is where you take your money and you let your money make money. So you put your money to work like your employee. Saving alone is not going to be enough in this economy. A lot of people have been taught to save. My dad told me that growing up. Make sure you got a little something on the side, which is great advice, right? As long as you're putting it into those high yield savings accounts and, as long as you're making that money work for you in some kind of way. So investing is important because it protects you from inflation. You got to think about in the past where a quarter juice was only a quarter, whereas now it's like $1, right? Although Arizonas have been on their game, they're still 99 cents. I don't know what's up with it. Are they still 99 cents? I haven't had one in a minute, but I'm pretty sure last time I saw. Anyways, inflation abides by the same rule, right? Where if something is $1,000 in your savings account right now, and that's worth something now, it may not be worth something like 5-10 years down the line, especially the way inflation is going in our economy. So you need to make sure that 1,000 is compounding interest or it's making you money. So that way it's not 1,000 in 20 years. It's actually 20,000 in 20 years, or 20 years seems like a stretch. It would be like 200,000 if you're investing correctly. 2 million. We're going to speak it. And you want to make sure that your investments are tying to the theme of your legacy. It is going to be something that creates long-term freedom for you. Think 15 years from now, what do you want your money to be doing while you're sleeping? Making money, right? So make sure your investments that you're investing into are tying into that legacy. So long-term, those investments are going to continue making you money 5, 10, 15 years from now. So yeah, as far as like a couple of myths surrounding investing, the first one is like that you need a lot of money to start. You don't need a lot of money to start investing. I've seen people invest with as little as like $1, right? I wouldn't recommend starting with a small amount like $1, maybe $10 if that's what you have. And do auto investing to start. And we'll talk more about that. But like auto investing is where you put your money in and they will invest it for you, whatever platform you're using. I mean, there's different platforms. There's like Public, Fidelity, Acorns, Robinhood. I'm sure a lot of you all have heard these. But yeah, another myth is that it's too risky. And the reason why it feels risky is because you don't know what you're investing into. So it's not okay to just get a stock from TikTok or Instagram because you hear other people doing it. No, like do your research on the stock. That feels hard to do because a lot of people don't know what they're doing. So I'm going to go more in depth on my Patreon channel where you can subscribe to. It's $5 a month. And I'm going to start creating little mini bonus episodes for the people to understand what each stock is doing, to understand what the ETFs are doing, things like that. But yeah. And the other myth, is that you have to be perfect with your money to start. You don't have to be perfect. Again, you can use auto investing, which the platform will automatically put your money somewhere. So you don't need to be perfect. You don't want to use just TikTok or social media platforms to invest, but you also can just use what the masses are using. So there's a few different investment vehicles. And again, I'm going to break that down throughout the season, but there's some beginner options you can use right now. There's like index funds and ETFs, which is like S&P 500, NASDAQ, US 30 is stock. That's Forex, but what's stock? Dow Jones. Sorry. If you've never heard of these, get yourself acquainted with them. S&P 500, NASDAQ, and Dow Jones. Okay, these are the largest. They're basically like a bunch of Fortune 500 companies together, and you're investing in this one particular fund. And by investing in that one particular fund, you're having a little slice of each and every single cake, each and every single company. Okay, the differences between the two, ETFs can be bought throughout the day, and then index funds are usually bought at the end of the day. So that's like the main difference, but really they're kind of the same thing. Roth IRAs versus traditional IRAs, slightly different. The Roth IRA is going to be non-tax, tax-free withdrawals after retirement. So that's a great thing if you have like a large, if you plan to be wealthy in retirement. And then a traditional IRA, there's always going to be a tax deduction at the time that you withdraw, right? So that one kind of just depends on where you see yourself in retirement, which I'm going to encourage everyone to see themselves as a higher paid person. So I would always go with the Roth IRA. And again, on my Patreon channel, I'm going to talk more in depth about those and also talk about why I don't believe a 401k and a pension are valuable. So you don't want to miss it. You can also invest into things like REITs, which are real estate investment trusts. It's kind of like having a little piece of real estate pie without actually having real estate, right? Until you're able to acquire real estate. Crypto, Forex, those are all investment vehicles too, but you need to know what you're doing with those for sure. Crypto itself, you can just buy, but there's a whole process to crypto, and I'm going to have an episode specifically for that. There's also fractional shares. So instead of buying the entire share of Apple, I don't know how much it is, but you can buy like a fractional portion of it. So that's another great way to get involved into the stock without having to pay the full amount. The strategy for the wealth circle, right? Because this episode is called the wealth circle. The strategy is to pick one platform to start. Doesn't matter which one you use. Fidelity, Charles Schwab, Acorns, Public, Robinhood. Alenia is one that I personally use. I love Alenia. You can start with $1, but the subscription is $120 a year, so you do have to pay that up front, and you're not able to cancel that until you withdraw your money, unfortunately. But there are great ways to do auto investing, so that way, if you are new, you're getting a chance to invest without having to do so much research on it, because a lot of people don't have the time to do that and don't know where to start. So yeah, start with like $10 to $50 a month. Just put that into your account and reassess quarterly, monthly, yearly, however much you have to reassess on how much you can do. If you can go up $100 a month, $200 a month, $300. And when you're making more money, you can add more to it, reassess. It's a marathon. It's not a money grab. Consistency is the key here. Consistency is what's going to build the legacy. So a lot of people get in this mindset of wanting to flip $5 to $500 overnight. Please don't get into that mindset. That's not how investing works. It just doesn't. A lot of us traders who trade Forex and crypto and things like that, we've lost money too, right? So, and that's because we're fast paced with it. If you want like long-term consistent results, you need to have a consistent strategy for it. And that's a whole other thing, again, we'll talk about later. But yeah, just don't think that this is a sprint. It's just run. Just keep swimming. Just keep swimming. Yeah. So anyways, tools and platforms that you can use. Like I said, there's Fidelity, there's Charles Schwab, there is Acorns Public. Alenia is the one that I'm using. You can always use the 401k. The reason why I don't particularly like 401ks is because of the tax deduction. It's so hard to get access to your money, but specifically the tax deduction, because imagine having worked all these years, right? And you make $1 million in your 401k, only for them to turn around and take this large sum of money, like 300k from you, maybe even more than that if it's $1 million. They take a large sum from your money. So it's kind of like, well, what's I thought it was my money, Now you're in retirement and they done took a large sum of it and you got to completely redo the structure of your finances in retirement. So I'm just not a fan of 401ks. Pensions, the reason why I'm not a fan of them is because they are not sustainable. They're based off of the company's success. If the company loses itself, you lose your pension. They might pay you out, but it would be like pennies to dollars. That's if you get anything. So that's why I don't like either one of those. But, if you already have one, I would say pull it and make sure that you're putting it somewhere. I've been telling my dad this for the longest. But yes, if you have something, make sure you're pulling it. Just take the hit for the tax deduction and then put it somewhere into a better vehicle, somewhere that's auto investing that money, right? Make sure you're reading like books, blogs, YouTube channels, listening to the Cash and Confidence podcast, because we're talking all about it, and subscribing to the Patreon channel that is coming very soon. But for right now, just join the VIP newsletter. I seriously send out really helpful tips. Last week, I sent the money map spreadsheet that I hand created for everybody that automatically populates how much you need to put into your fund account, to your investing account, and into your charitable sinking fund, right? So if you're using that spreadsheet that I sent, you see how much it is that you can invest. Take that 20% and invest it. If it's $200, baby, what? You gonna have $1 million in a few years, like 20 years. You want $1 million. Okay. And another important thing to understand is when it comes to investing, you've got to hold. The market is going to go up and down. We just seen recently with the whole tariff stuff, which that's a whole other thing. Again, we'll talk about later into the season, but you have to understand that the propaganda is going to help assist with the institutions moving the market. If you get what I just said, you get it. But the institutions are the ones who are moving the market, not the retail traders. So you have to understand that the money is going to drop, but hold on. Hold on for dear life, because it's going to go back up. So when you see drops like that, make sure your first initial thought is accumulation. How do I accumulate more from this drop? Because I understand it's going to go back up. So now it's just about reading the market and understanding when is it going to go back up. Listening to the news and understanding what's going on, because that's going to kind of give you an indication on what the market is going to do as well. Actually will. And then it starts to go back up. And everybody who sold all of their shares feel bad because they're like, dang, why didn't I just, it was dropping so much. People pulled all their money out. That's exactly what these institutions wanted from you. They wanted you. This is the market power. They wanted you to pull out that money because you are liquidity. So don't quit. Be prepared for your money to drop by 50% and be prepared for the market to go back up and making money, and be sure to accumulate. Don't wait. Get in. When you start seeing the market moving in that upwards direction, just don't even wait. Buy. When the markets dropped, I was immediately thinking to myself, how do I accumulate? I got to drop more money in my Alenia account. Do that. Okay. Sorry. I go on little rampages. I told y'all I'm a yapper. That's why I started a podcast. Some of y'all have feedback on that. You'll be all right. But yeah, make sure that you're subscribed to the VIP newsletter, because I am going to be sending out a Wealth Circle starter pack, and it's going to give you all the resources and the tools that you need for getting started into investing. If you're not already investing, if you are investing, that's great. But this is still a great pack to have so you can continue investing, build yourself up. It never hurts to create more success. I want to do a call to action. I want to encourage you all to go open the account this week. Whatever account it is, whether it was your high yield savings account from episode 2, whether it's your credit or debt loan, so that way you can start building a legacy using debt, whether it's the credit union because you're no longer using a bank, investment account, whatever. Open up the account, okay? Just do it. Even if you don't fund it, open it and then work towards funding it. That's my call to action for this week. So to wrap all of this up, I want you all to understand that you don't need to be rich to invest, okay? Investing is how you get rich: in values, in time, in options. That's how you get rich. Just do it, because who knows where that success is going to be at. And even just a year, you could have built 300 into something special, depending on how the market moves and what it is that you're investing into. Invest in your knowledge always. I tell y'all that always. You're not behind. You're just getting started, and you're doing it right. You're doing it the right way by listening to Cash and Confidence. I'm really giving the blueprint. I mean, I'm telling you exactly what you have to do. Remember, first episode is switching your mindset. Seems like if you're listening still to episode 5, you've done that. Episode 2, we talked about making more money, because that's what you're going to need to do any of these other steps. Episode 3, we talked about credit and debt and leveraging that to build your credit so you can start pulling out money to do other things, because you could really just pull that money out. You could invest as well. Once you have those higher limits, you can use those higher amounts to start investing. That's the best way to do it, honestly. And then creating that money map and guiding your money on where it is exactly that you need it to go. Me giving you that money map budgeting template was to break it down for you so you can see exactly how much it is that you can spend on fun and do not go over that. See exactly how much it is that you can spend towards investing, and then start creating an idea of, this is how much I'm putting in weekly towards investing. So this is where I should be at in 20 years. And then your 10% for your sinking fund. So that way you've got a little something saved up if something happens. Literally, if y'all are listening to the podcast, for real, man, I'm dropping gems. I'm really giving y'all the thing. And as the season progresses, my goal is to talk more in depth. I know right now it all seems very surface level. That's because I'm just trying to get y'all there first. And then ultimately, I am going to start breaking down the real heavy stuff. My bad, y'all. I am going to start breaking down the real heavy stuff. Like, going more in depth with trading for those who want faster money. Going more in depth in how the market is moving. We need to understand. This is the thing people don't realize. You need to understand how the market is moving to understand what you're investing in. You have to. You got to know what the market is doing. That's why I want to talk about it. And sometimes I do get yappy. I'm sorry. It's because I am a yapper. This is a podcast and I'm going to talk. I'm going to do my thing. I'm going to break down for sure, like, the real stuff that people need to hear. And I'm doing this not just because I want to help y'all out, but also because, like, my kids can listen back to this and then they can create that legacy. If God forbid ever something happened to me, hopefully not, but prayfully not. But, this is there's a bigger purpose to this. There is a legacy to build here. So, Anyways, guys, that is episode 5, The Wealth Circle. Be sure to tune in for the next week's episode. I don't know what it's going to be about, but it's going to be good. And be sure to subscribe to the VIP newsletter as usual. I'm going to be sending out helpful tips every Wednesday. And yeah, guys, rate, like, comment, subscribe, all the above. And until next week's episode, namaste.